Since about 2000, the growth in agricultural exports globally, forgetting Australia for a minute, has been quite spectacular. And I think we heard yesterday that about 70% of that trade is now in and out of a country. In other words, it's trade to a country that then comes back out of the country. So obviously the financing arrangements around those trades have become much more complex and comprehensive over that period. Is it becoming normalised? Is the risk reducing? Is it becoming easier for participants to be involved in export markets than might have been the case in the past, do you think, each of you, or is it still as complicated as ever? Who's going?
I'll have a crack at it. In a sense, the Scottish started building boats and decided that they wanted to load them, send them over south to America, down to Africa, pick up some labour and go over there. People have worked out models and schemes to put money into the marketplace. That's how a lot of those futures exchanges started. And then once you had price certainty, people would advance money to facilitate the trade. I actually think we're going back to a little bit of that model. Financiers and funds are saying, I'm happy to be in that space, but I don't actually want the operational risk. But they have to hop into the tools of trade that the traders are doing. It could just be simply to go in there right now because it's on and it's a low interest yield environment, but I think financiers and funds are happy to take on or accept some of the processes that importers and exporters and traders have got, saying, yeah, you have got a good contract system, you have got your risks under control, we're happy to follow the path of the asset, send the money back the other way.
Karen?
Not too much yet. I think we do see a fair amount of, kind of processing through different markets. We probably haven't seen it as much in the agri space as in other sectors, but we do also try to take that into account from EFIC's perspective, where there are financing gaps to be able to facilitate that. But we think some of the private market seems to do that pretty well.
Yeah, I think the buzzword in banks at the moment is cross-sell. So I agree with what Nick was saying. I think they're happy to take on additional responsibilities or different or additional operational requirements if it allows them to do something else. So it allows them to capture another flow, or you put in a structure where you are providing administration or providing hedging, then that then can provide for their sugar book, for their coal book, for their iron ore book. So it's more about understanding how much of the pie can be cut up, and then seeing what you can do about cross-selling your product into those various offerings.
Yes, we've got a question, Suzanne.
I'm interested to hear about the regulatory oversight that actually exists covering over the top of this. Obviously, I've got a long background in commodity trading. I cut my teeth at Glencore as one of the lawyers in private practice. The FSA in the UK has the energy market EMP exemptions, which allows banks to take a proportionate market position, which is pretty much around the 20% mark. If you don't fall under the EMP rules, then you can't be taking a physical position. So the cash and carry isn't possible in the English market, and to a large extent not in the US market either. And I'm quite surprised to see that in 2015 we're still permitting cash and carry in Australia. And in terms of actually taking a market position, and what is the regulatory oversight? Because I was around, I saw TXU go under, I saw Enron go under, I saw Aquila go under. You saw the market positions and you saw the market just about fall. It's fantastic to see all these new markets and these new opportunities coming into the agri space, but where is the protection for the underlying business? Because a farmer's not the BP who can take the hit on the balance sheet when Enron goes down. So where does the farmer get protected with these fantastic innovative products? What's the regulatory oversight and what's the protection that exists?
Now, before we get an answer from any of you, I'm just warning you that TLA is a band. 3-letter acronyms, in case you're wondering.
Oh, good, I better say this TLA. Look, that's really topical. some people have got into that space and probably haven't behaved well. You've seen it in aluminium, you've seen it in oil, and they said they're a bank, but really they're a trading business. And I think it's a good thing that people have clamped down on that. I don't work for Commonwealth Bank anymore. What I can share with you, they're not that style of business. They just use these products, and there's other ones. I'm very sure Bravo and NAB and ANZ and the other guys within Australia are fairly similar. They want to service a need for a client, and really what they want to do is own the inventory to lift their security position. Regulation in the market is well through the market, and the ability to trade, as in take a proprietary position, is being clamped down on. And if the institutions themselves don't create some oversight, I can honestly share with you that the organisation I work with, it was well under the levels you're talking about. The theory is look after the client, give them what they need, demonstrate that it is what it is, but don't trade against them because they won't come back. So I don't know whether self-regulation is the right answer, but my experience here in Australia is it's still a small market. Do the right thing, and you should be right.
Yeah, I mean, for my business, the regulation is pretty intense. There's APRA, there's the DMB, which is our home market for a regulator, and there's the ECB. So in relation to and I agree with Mick, I'm not taking proprietary positions. I am simply providing a solution which allows inventory to come onto my balance sheet. I then get capital benefits internally in relation to my cost of funding, and I can provide a cheaper source of funding to the customer. All underpinned by true sale, and all underpinned by whether it be a repo on balance sheet, whether they're more sophistication, that's up to, I agree with Mick, it's all up to individuals, auditors, but in relation to regulation, it's a significant amount to ensure that we don't breach what has happened in the past. And I think APRA, as our home regulator, is very on the ball in relation to what these products do, and ensuring that we're not playing in markets. And also, I'm not a trader. The Glencores, the Cargills, the ADMs are the traders. What I'm trying to provide them is an alternative source of funding to allow them to do more.
The other issue that has been raised in the discussion is the use of hedging and forward contracts, and the fact that certainly traditionally in most markets, perhaps with the exception of cotton, Australia's been a spot market in terms of agricultural products, and obviously that has limitations when it comes to financing because of that. Do you see that changing? Do you see either forward contracts becoming more common right back to the farm gate, or do you think there is real prospects for growth in for example, the futures markets and the swaps markets that allow some management of that price risk?
Australians, particularly producers, take a hell of a lot of flat price risk, so they use forward markets or spot markets or classic Mallee farmer. They never sell until they've got it in the bin and the next one's already in the ground and up. But there are others who go forward. The weather's an issue, particularly for croppers, because your outcomes there can be, well, they're not truly binomial, but they can be, obviously. It's quite topical now. That's why I think the concept of basis contracts. I want to do business with you. The parties agree. They agree on the spread that they're going to do it at. Hopefully you've got enough flexibility there. And then you can do your pricing differently. If you just either forward sell, you've got the supply risk, you've got to deliver, and equally the buyer's got to hope that the producer can deliver. If you just spot sell, well, the markets trade for anywhere for 2 years in advance and at least a year afterwards. So you're leaving yourself out of 2 years of potential price opportunities. And you've only got to have a look at the volatility in the markets to see that there's good times to sell if you're a seller and there's good times to buy if you're a buyer, but they don't all come together. So I do think if we had a deeper, better futures market, a lot of people wouldn't have to take on a lot of that flat price risk they do with forward contracts. And I think that'd be a better thing to see.
Michael, just on this question of not having an adequate futures market in Australia for agricultural commodities, I guess our history of agricultural marketing sort of bound us into that situation. If I'm correct, I think the Sydney Greasy Wool Futures Exchange is one of the early futures markets, and of course that disappeared with the reserve price scheme for wool. Sugar, I guess when we were a major exporter, it probably would have been logical for Australia to run a futures market for sugar that we were bound with single desk selling at that stage. So that history seems to me to have contributed a lot to this situation that we've got.
Yeah, true. The sugar industry we don't need our own local future sugar market. We're fine there. I mean, it's a global market. It's pretty homogenous. And actually, Australia, you can deliver into the New York Futures Exchange. It's a FOB market, so if you load a boat, it's deliverable. The grain industry, that task was done by the AWB historically for wheat for years, and the relevant barley boards, and they've been going to the offshore markets just simply because there is liquidity there. Those guys even got caught up in those big price rallies. They're hedging Australia's crop. They've got to keep paying the margin. The amount of hurt that went through in 2008 was phenomenal, and that's led to big companies. For the commodities that we are good at and we've got a good market, it would be good to see a deeper futures market. The knowledge base in the producer land is quite good. It's exceptionally good. They've just got to be comfortable that the liquidity's there. Every farmer who rings me up and says, oh, there's not enough liquidity in the ASX grain market, I go, I'll guarantee you we can buy and sell more today than you'll produce this year. But still, a lot of them are just trained to run one way. But I think it would help assist the funding side of it at least anyway. But I think maybe beef's the one that needs the opportunity there, to be quite honest.
Looks like we've come to the end of our questions there. We've actually finished reasonably on time. So I'd ask you to thank our three speakers for what's been a quite interesting session. Certainly an aspect of trade and trade policy that we don't necessarily think about, but obviously quite a critical aspect of the whole business of getting Australian product to markets in the many and varied nations to which we trade. So thank you all very much.